Good afternoon, everybody. Thank you for joining us. Hot button topic for everybody, debt. Breaks deals, breaks refinances, many times makes or breaks a developer. So we've assembled a great panel here. My name is J.R. Patel. I'm the Chief Executive Officer of Pi Capital, a Chicago-based family office, as well as a founder of Helix Hospitality, a fully vertically integrated hotel company. The point of this panel is really to talk about the state of debt, particularly in the 1 to 25 million space. This is your typical sort of mid-scale to upscale asset, plus or minus 100 keys, generally falls in this deal size. So I'm going to pass along to my panelists, let them introduce themselves. So gentlemen, please take it.
My name is Adil Amin. I run capital markets in part with my counterpart for Hunter Hotels.
I'm Samir Ruparel. I work with GBank, and we focus on hospitality lending up to 10 million.
Hey everyone, Dan Dyer. I'm a managing director at Wells Fargo in the hospitality finance division. I have primary responsibility for loan originations for both balance sheet financings in hotels as well as capital markets financing.
Hey everyone, Vamsi Banthala, co-founder and CEO of Arbor Lodging, based out of Chicago, but have a national platform both as a debt and equity investor in hotels and also an operator of hotels.
Thank you, gentlemen. Let's kick it off. So what everybody wants to know is, what does debt cost right now? Is it available? So Adil, maybe you can tell us a little bit about current trends, rates, spreads. Many of us, myself included, built our businesses on relationship lending, conventional, cheap lending that was out there. Is it available? Are relationships worth anything anymore? Where are things pricing?
Yeah. So I think over the last 24 months, we've seen a pretty big metamorphosis when it comes to hotel financing. A lot of the things that were happening between 2010 to 2019, they're really not there anymore, but that doesn't mean that capital has evaporated, it's just transformed. So we're still seeing a good amount of capital on the markets as far as conventional financing is concerned. In fact, we just got pricing on a couple of properties out of anywhere in the world, West Virginia, and there were banks willing to lend all the way up to 70% loan to cost on a swap over 2-point spread, which today would be a 6.3, 6.4% on a 5-year fixed over 25-year AM. That's about where you're going to get the lowest, cheapest rates on swaps for conventional financing for properties that are in that 1.4 to 1.5 DSCR. That is the magic ratio. It's not LTVs. It's not where you're buying things at. For bankers, I'm sure my two counterparts here can tell you, those are all back-end scenarios. We're really taking a look at where properties are cash flowing, where they can make debt service, and kind of crafting a strategy from there. Beyond that, I think conventional financing is limited. I don't see a lot of projection-based deals happening on conventional financings. It's the number one story that I get, hey, what's conventional look like on this particular asset? I want 30% down. And you're kind of starting all the way at the back, right? You're not really talking about where the deal's cash flowing today, which is where banks really want to know. CMBS, non-recourse financing, we're seeing spreads even for debt sizes of anywhere from 8 to about 20 million, right around 3% over 5-year treasuries. Some get pretty competitive depending upon your debt yields. We've gotten some done at about 70% financing, which frankly, I haven't seen personally in the last 12 to 15 months. That's now coming around. Non-recourse financing, which we can get into in a little while, that's also available in conventional markets, that's still around. Anything that I feel it's a here to there project, meaning that we're going to come in, we have cost cutting to do, we're going to go and make it something huge. That's predominantly bridge or SBA, the 3-letter word. Everybody hates it. I'm not particularly fond of getting a lot of SBA things that are there. It's process intensive, a lot of documents there, but it works. It funds without a lot of people asking a ton of questions. There's really no fallback from committee meetings, and that's one way to bridge your debt. And for bigger deal sizes, I think bridge financing is becoming incredibly aggressive. 70% loan to costs, available pretty much everywhere. Rates are in the SOFR plus high 3s, and then that's continuing to get more and more and more aggressive.
Okay, so that concludes the panel because covered
it all.
So you mentioned a lot of things, CMBS, SBA. Samir, can you tell us a little bit about SBA specifically? Availability, its role in the current environment, availability, pricing. Give us some high-level details.
Yeah, so SBA has grown a lot. So when you look at the fiscal year of 2023 versus fiscal year of 2024, volume's gone up by about 22%. So when you look at SBA, there's SBA 7A and SBA 504. In 2023, that total was about 3.1 billion, and it went up to about 3.75 billion in 24. So the availability is there. It plays a huge role in transactions, especially in this space below 20 million. 504 looks a little bit more at stabilized properties. That's gone. It's a little trickier, and Adil can probably attest to this. There used to be a lot more bigger players that were more central, and that's sort of spread out. And it sort of ties into relationship banking. So with 504, it's more mirrored to conventional lending, and a lot of lenders will just do one-off transactions where they have relationships with certain borrowers. SBA 7A, there's a lot of value add there. So when there's a PIP, you're looking at deals where you can increase the NOI and profitability. SBA 7A comes into play there. So we're seeing a lot of that now.
So SBA 7A does help with the ramp-ups or more pro forma-based deals.
A lot of pro formas, a lot of PIPs. So you'll see the $2-3 million PIPs come into SBA 7A with a pari passu structure, and you'll see a lot of deals in SBA 7A. They just don't cash flow on an as-is basis. We're looking at the story. We're looking at proven operators that have done it in the past, and maybe they're taking a little bit worn down, beaten down property that just needs that refresh to increase the top line, and with that incremental revenue, increase the NOI margins.
And what's the SBA's appetite on independent versus branded?
Technically, independent is allowed. It's more lender to lender. So you really have to paint the story. If you're going to independence, you want to highlight your demand generators that are in the area. You want to really highlight your ability and expertise in that. So it's a little bit harder if you're doing an extended stay off the highway in a rural area as opposed to a beachfront property, maybe in Volano Beach, where there's a lot more independent properties. So it's really market specific. And you just really have to highlight your story.
Outstanding. And Dan, on the CMBS side, I know maybe not on the smaller balance, but on the larger balance, can you give us some more indicative terms? I mean, we've heard more conventional SBA. How's the CMBS world looking?
Yeah, it's a great question. So the CMBS market has really come back in a big way over the last really sort of 18 months. So in 2024, total issuance was $106 billion. That's a 170% increase over 2023. So really came back, and we'll talk about how the bank market sort of correlates to that. But all throughout 2024, spreads were tightening, and so we saw a 100 basis point decline in CMBS spreads between 23 and 24. Here and now, today, year to date, the market's issued about $32 billion, which is a record for that market. So 2025 on pace to be a record year for the CMBS space. Spreads have held in. We have seen a little bit of widening in the last 60 days from the lows we saw in January, and that's really a function of just in bond buyers having a lot of deals to look at and a lot of deals to underwrite and choose from, and so they can pick one deal that's got a little bit more premium than the next. And they'll spend their time on that as opposed. So we've seen a little bit of widening, 10 to 15 basis points, but by and large we are still very close to sort of historic tights in that market. It's a really constructive CMBS market today.
Thank you. Vamsi, when you guys are going to acquire a hotel, you have all these different vehicles. What's your decision making? When do you consider an SBA? When do you consider conventional, a swap, a CMBS, a million different products, a million different vehicles? What's your decision-making process on what type of debt to place for the type of investment or development?
Yeah, so we invest on the equity side out of a few different buckets, and so we generally have a different mandate or a different goal on an asset-by-asset basis in which you then match the debt. I think what the fellow panelists have made clear is there's no shortage of liquidity in the credit markets right now. It's a really great time from a perspective of trying to get a loan. The question is going to be cost, and that's even on a relative basis come in a lot versus 12 months ago, and certainly 24, 36 months ago. I'd say the biggest sensitivity point is going to be on proceeds. And that's just a measure of what your total debt service is. And if you went and did a loan 5 years ago and you're trying to refinance it now, or did a loan 10 years ago, the math just doesn't math. You're not going to be able to get the exact same proceeds. And so you have to think about a few different ways of how are you going to put in extra equity? Are you going to go get mezz or pref? But decision making for us, I mean, our starting point, our default point is we're generally non-recourse borrowers. We think that there's plenty of options out in the marketplace, not just CMBS, but even from bridge lenders, debt funds, banks, that if you can start there, and based on where general pricing is coming out right now, it's worth it to pay what is a relatively small premium to get non-recourse. That window fluctuates based on what is perceived as risk in the marketplace. And so there's certainly times when you can get a really big premium for putting on some recourse, and that's obviously a personal decision. I think in some cases for us, we've done one recourse loan ever, and that's because we had a really tight ownership group. And I had a high level of confidence that we were going to work together, and that we knew we were fully aligned during bad times if capital had to go in. And so at the end of the day, that's what it really comes down to. On the other hand, we do a lot with large institutional capital partners. And it's not to say that we're not aligned, but there is a bit of a mismatch on those type of situations given their positioning and us as the sponsor. And in those cases, I just sleep a little bit better knowing that it's non-recourse. And so I think that's really what kind of drives it a lot of times. But again, I think the great part here is there's been a lot of moments over the last 5 years where it's there's that one particular bucket that you can get money out of and everybody is shut. Right now, everybody seems to be open, so you can be, I think the best thing you should be doing is making, I mean, some of the lenders aren't gonna wanna hear this, but you should make a market for yourself. Go talk to a few different people.
You pointed out 3 really important things, and I want to dig into each of them. One is private credit. Private credit is prevalent. We all see it in our emails and the headlines. What is it? How does it play into building a capital stack? Is it a debt alternative? What's the longevity? What's the use case for it?
I mean, we're on that side, so I could answer that again. I mean, I do laugh at the term private credit. I'm not really sure what it means. It's just credit. And so I think, for us, we are lenders across the capital stack, so senior and pref and mezz. And so senior, I think everybody understands. That's your senior mortgage. We are not going to be as cheap as a bank. There's a reason people go to banks, but the bank is also going to have the least risk tolerance. So they're going to be looking for the highest debt yield, the highest coverages. We can take story-driven assets, and that's really where we can be helpful. We're not going to be tied to a specific debt yield today. It's a lot more about where do we think this asset's going to be, and do we believe in that story? And as everybody's fully aware, you have to pay up a little bit for that. You're not going to get it as cheap as a bank because on a risk perspective, we're taking more risk as a lender. I think the part that people are going to probably have to just be more aware of because of lower proceeds right now is pref and mezz, which is gap financing. And so that's going to sit in the capital stack below the senior mortgage, but above your common equity. And that is, we're doing a lot of that right now, especially on the smaller balance to help fill out the shortfall on proceeds. If somebody has a wherewithal to do it through common equity, that's certainly going to be cheaper. But if they can't, then that's the option.
Maybe you and Dan, can you guys explain? So typically deals in this size historically weren't really candidates for pref and mezz. The check size was too small. What is preferred equity? What is mezzanine financing? How do you explain where it fits in the capital stack? Your equity slug, you have this pref or mezz slice, and then you have your senior debt. Is it debt? Is it equity? Is it both? Does it have any claim against the asset? What's the risk? Can you guys maybe walk us through that a little?
It's equity. So it's a little bit of both. So I think the key is if you just look at the face value of it, it's going to look like equity, but it has a cap. So the difference is on equity, theoretically, you have unlimited upside. If you just absolutely hit a home run, you as the risk taker on the equity side get all the upside. I think here, if there's a payoff that happens, obviously the senior gets paid first. So, and they're presumably current. So They're just going to get paid off whatever is the outstanding principal balance. Then at pref or mezz, and it sits the same place in the capital stack. The difference in terminology is frankly, if it is a loan, in which case it would be a mezzanine loan, but it's going to be unsecured. Your mortgage is secured by the property and everything else in the hotel. Or if it's preferred equity, it's coming within the operating ownership. It means it's preferred. It gets paid off first with a return that's attached to it.
And open to the panel, but what's the availability of this? Do you guys see this being used frequently, regularly? What's a typical use case? Is it on a development, a major value add, an instance where maybe two developers or sponsors are coming together to put a larger project together? What's the check size? When do I call somebody and say, I'm looking for a pref or I'm looking for a mezzanine slice in my capital stack?
Just where you run into pref and mezz is probably deal sizes that are a little bit larger than 20, 25 million, just because it doesn't make a lot of sense for mezz individuals to play in that 5 million space, although I think Vamsi's actually got some interest in playing in that area, developing, and we're seeing some activity come in that space. But when you take a look at non-recourse financing, it's all driven by debt yields, right? So if you have a property you're buying for 40 million, but it can't service more than 15 to 20 million dollars worth of debt, where do you come up with that capital stack? Those are the situations where you would look to somebody that's a mezz or a pref lender to help you get a stretch, which is what we call those types of loans, where you can actually pair a senior with a mezz, put that together and actually get more injections. Mezz is not as sensitive to debt yields. It's more, it's more open, it's more creative. It's those are individuals that are a little bit more, they're private credit, but they're not as tightly woven around where things are actually cash flowing. They're willing to hear the story, of hey, where you guys are going, how are you going to take a space and actually get a little bit more of a toehold in it. So it's a little bit of a different underwriting on those sides. So if you have something like that, because all these vehicles, mezz, pref, they're typically non-recourse types of assets that we see a lot of individuals playing into.
And a mezz lender is really looking, to your point on underwriting, they're really looking at their last dollar risk, right? A lot of these lenders are both owners as well as lenders, right? Versus a traditional bank. We don't want to own the asset, right? That's a really bad day if a bank takes the keys back, right? But so a mezz lender, when they're looking at their downside, they're saying, okay, if I'm going to step in here, I can own this, I can manage this, and here's my last dollar, and I'm 60% of the cap stack, 70% of the cap stack, and I feel really good about that basis, despite what the cash flows may be today. So I think that's another element.
So we talked about deal size. 1 to 25 million is a massive width of deal size. For intents of this panel, I'd like to split it into two and get some options and ideas. If I have a deal sort of 1 to 12 million of debt, Samir and a deal, can you guys maybe tag team? I came to you with a XYZ, I'm not favoring any brands, I promise, XYZ branded 100-room, 10-year-old box that may or may not be cash flowing, or an independent that may or may not be cash flowing. What are my options? How do I build my capital stack? Where would you take it? What's option one? What's option two? What's option?
I take it to G-Bank first. Number one, they've got the cheapest SBA 7A debt that exists, I think, anywhere in the country. It's at Prime Plus 1. They had a discount because we're good citizens at Prime Plus 0.75, I think, for a while. I mean, if you're taking a look at it, that's about 8.25%. They'll give you a 12-month interest-only free ride, right? It's 36 months of a prepayment penalty. That's a 5.31, 5% first year, 3% second year, 1% the year after. And they're extremely lenient on, we've even funded deals that have had no cash flow, up to that point in view. Things that were completely torn apart at 80% loan to cost. So forget about where it's cash flowing, but where it's about headed with a business plan, a solid, leadership, that's actually there. So I think, in my opinion, G-Bank does a great job with that market.
Yeah, and then what we see also from competition, I mean, USDA is an option. And then going back to what a lot of people have talked about at this conference is relationship banking. So where do we lose deals, right? I lose it to conventional lenders from time to time. They'll come out, they'll step up for their regular customers and borrowers. So, you take advantage of that, you press your regular lenders, you grow with them, you press those relationships. They will give you deals that I can't do. They'll do it on value add. They'll do it on development construction. That said, when you've exhausted your relationships, SBA is a great platform, whether it's 7A or 504, and a deal can attest a lot more on the 504. I don't do any 504 at all. And also on that, he works with a lot of the independents. So from what we see, it's usually just demand generators. That's what we're looking at. And it's got to be a really, really strong deal. For us as a bank, we view independence a lot more conservatively. As an industry, SBA allows for it. You can get that leverage that you can't get elsewhere. You can get the pro formas. And there are lenders out there that do understand the benefits in certain markets, why you don't want the flag and why that cost is there, and it's just taking away from the bottom line.
Right. So I think in the stack, SBA 7A used to be a staple inside the $1 to $25 million, more $1 to $15 million asset sizes, right? That's everybody that's kind of getting reset that's coming into this market used to be on prime plus 1 from 2016 onwards, and that was 5.5% interest rates, and they kept adjusting and adjusting and adjusting because that follows the Fed. So today, I think it's a good alternative, in that regard with the potential bridge financing, right? So that's, one of the uses that you have is that it's temporary. You kind of get in, it's 24 months to go ahead and stabilize, do the conversion, do the PIP, and then you have an exit event where you can refinance potentially off of a conventional or convert it to a 504. Right, so it does often, because you don't want 8.5% financing and wait for the Fed to continue riding that coaster down. There are cheaper alternatives, so that's been the upsurge in what we've seen with 7A. Which, by the way, he didn't mention, you can take it beyond the $5 million mark. You can go all the way up to $10 million with GBank. People don't know that because there's a $5 million per individual limit, but they're actually one of the few banks that will go all the way up to $10 million as far as their debt sizes are concerned.
Now in the 12 plus million space, 12 to 25, different ballgame. Give us flavors, guys, of cash flowing assets, performing assets, more pro forma based. What's available out there? Where do you take it? I'm your borrower. I have a great deal I'm just putting under contract. How do I build my capital stack?
Yeah, so at Wells, we're in our hotel group, we're about a $10 billion book of business. Most of those are larger than that size, but we do a decent amount of sort of select service in that zip code. So what we don't do a lot of is construction financing. So about 5% of our book is construction. As one of the sort of three giant banks, our cost of capital just doesn't really make sense. So for to do construction, so it's really challenging for us to make returns work in the hotel construction lending space. What we do a lot of is the renovation and reposition deals. So that bridge loan, 3 years, maybe a couple extension options, max of 5. That has a real business plan, right? Maybe it's a renovation, changing the brand, a change of management, something where you're coming in and you're gonna sort of sprinkle pixie dust on it and make it a lot better. And so in that case, we really do lean into the forward, and we have a whole division within my group that are former appraisers, former feasibility analysts, that just day in, day out underwrite hotel cash flows. And so, and that is, unique to Wells compared to our bigger peers, that we can really lean into that forward and buy into the business plan. I think the most important thing there is you really have to tell your story, why it makes sense, where you're going to take cash flows, and back it up with the data, right? The more you sort of spoon feed your lender the information, the easier it's going to be to get it through a credit committee, right? So I think that's really important. So we do that, and then we do the standing loan sort of as well, just sort of cash flowing. It's DSCR, it's debt yield, it's loan to value. Those are our sort of metrics that we're looking at, and we'll go up to 65% loan to value. And sort of the DSCR really depends on the business plan. Is it stabilized, or is it some sort of a repositioning loan?
I'm going to move us forward here a little bit, but this is one of my favorite parts of this panel. It's for you guys to expose what you're willing to give up in a negotiation, right? So maybe not you guys directly, but what do our attendees, what should they be asking for if they're going to a conventional lender, an SBA lender? what is available, what can you ask for, what can't you, what type of creative terms. With Bridge, we have some more entrepreneurial type of debt that's private. What can be done, what can't be done. And this is open to the full panel. Each of you kind of have a flavor of your background. Please share with us what you're willing to divulge.
Yeah, I like the bankers go first. That's going to be interesting for me to hear too. Yeah.
One thing that's been surprising is especially with, for borrowers that want to max out the leverage, is sellers are more and more willing to take on seller notes. So they will take seller financing. We see it a lot more in SBA, but I've seen institutional sellers that you'd be surprised, REITs, they're willing to take a small standby note just to get the transaction done. And I think with all the major PIPs that are coming out, Marriott, Hilton, IHG, they're pushing all these PIPs out. If the sellers are genuine and they want to unload those properties, they will play with you. So don't be afraid to ask for that. That will help you regardless whether you go conventional, SBA, Bridge, whatever it is. Don't be afraid to ask for it.
Yeah, I think it's really, do you need to maximize flexibility, and so is structure most important or is pricing most important, right? And as a traditional bank, if you're willing to live with more structure, maybe there's partial recourse, maybe there's a hard remargin, covenant, maybe there's amortization. If you're willing to live with more structure, you're likely, the lender or traditional bank can give a better interest rate. On the flip side, if you need a more aggressive structure, then we're going to look at that through a risk-adjusted return, just like any investor would, and it's going to be priced higher. So I think it's looking at the business plan and being creative and designing something that works for the asset, right? Is it reposition? Is it a standing loan? Can you live with structure, or is pricing really the thing that you can give up?
I think where some of this kind of gets lost is that where people come with expectations of a bank being able to take the entire deal down all at once, right? And basically what they're talking about is potentially breaking it up into certain bits. There's banks are looking at for where the deal is cash flowing, right? They're not caring, and I mean this respectfully, everybody's got wonderful plans, but they really don't care about the here to there story. They're caring about historicals, right? Where our things are at, what has the impact of tariffs done? Are you losing any government business? What's going on around your area? Are you used to those things? Are you used to kind of building a hotel in those areas? And that is where all the fixed money is going to focus on. That's their underwriting. I don't think it changes. I think the brand, the flavor changes a little bit, whether you could go CMBS or conventional and things like that. But they're all fixed around the exact same type of underwriting criteria. I think if you have a deal at that rate that you're like, okay, well, I'm buying it at 20 and I think it cash flows pretty well at 15, and I'm willing to put in the $5 million equity, I think that becomes a lot easier conversation to have with a bank in one shot. If, on the other hand, that deal's at 30 and it can only service $14 million worth of debt, that is where you have to start getting very creative between seller notes, between mezz financing, pref, and what are the other things that are that we can combine to get you to the capital stack of where you think it's going to be functional. And then moreover, the additional analysis is that debt kind of worth it at that point, right? I mean, like, does the property, can your business plan envelop that debt? Can you service it? And then effectively do your exit, whether it's a legacy hold or an exit hold from 3 to 5 years. So, I think you have to factor that in.
The other thing I would add is I do think there's more or less a box that most lenders can operate in. You'd like to think that there's like a theoretical approach of, if I go down to 25% leverage, the risk is nothing, so the cost of capital should be a lot less. But they all have their own targets on what they have to achieve. So at some point, it doesn't really matter. I think the goal is to be creative and think big picture. Like with some banks, sometimes it might just be moving over deposits, and they might be able to work with you a little bit on the spread. And I think structure is really where you're going to be able to push it more, because at the end of the day, the economics are going to have to fall into a certain bucket. But the other reason it's good to talk to people is it's also just about catching people at the right time. You might be working with a bank that's going to be putting it into a CMBS pool, and they just have to fill that last $14 million. They're probably going to work with you a little bit more than if they're just looking at it in a vacuum. And so sometimes it has nothing to do with the deal. It has a lot to do with everything that's going on behind the scenes that's going to help you with better economics.
I think your point on deposits is hit on a really good issue, because for, again, traditional banks, we're not just in the business of lending money, right? We're in the business of treasury services, wealth management, investment banking, capital markets, right? So if you can offer your lender other ways to make money, right? I've got treasury with this bank, I'll move part of it to you. I've got my wealth management of my estate with XYZ Bank, I'll give you some of it. That is going to be a really big needle mover for the lender, and you're going to get a better execution if you have those services. Or looking across your wallet, what can I do to generate more business with this lender? That's going to go a long way.
And no one's going to ever make you commit to keeping those deposits there, so use that advice how you want as you're shopping around.
Very important point. So we've got a lay of the land in terms of what is available, where things are pricing, where spreads are pricing, availability based on particular use or sort of business plan of an asset or of an acquisition or development. Where's the future? And so I want to leave some time for questions here at the end, because I know we're going to get bombed with questions. Everyone's super excited about this, so I want to leave lots of time. But give us a 1, 2, 3 sentence response. Where are rates going? Where's the overall condition going? Do you think leverage gets better given overall market conditions? And we'll just run through each of you guys. Give your personal opinion where you think things are going and pricing is coming in, overall availability of debt. Give us your future outlook.
I think conventional markets and CMBS, from what we're seeing, is that the spreads are actually tightening. There's a lot of liquidity coming inside. I think I gave a stat to our team on Monday that last year we were struggling with 60, 65 private lenders. This year, I think I stopped counting at about 120. So there's a lot of brand new funds that are coming in that want to fund bridge. The CMBS sides are far more aggressive. Conventional rates are actually, we're booking conventional loans, even though it's not what people thought. So I think it's optimistic, but I think it's more along. It's definitely, there's a microscope on the individual asset at this point.
Is that 12 months, 18 months kind of outlook?
Yeah.
Yeah, availability of credit's there. I think deal flow or deal volume has gone down a little bit over the past few years. So lenders are fighting to get deals done to deploy their capital. Bank balance sheets aren't bad; they're pretty strong. We need money to deploy, so there's availability. You have capital markets advisors. I would talk with them, leverage a deal. He can find you the different deals, right? It's like, hey, I want to look at SBA. I want to explore 504. I want to explore USD. I want to explore CMBS. Explore your options. There's a lot of capital available. You'll be surprised.
Yeah, and when it comes to base rates, I once had a credit officer tell me, if you can predict where base rates are going, then you shouldn't be at Wells Fargo, you should be in Vegas. So I think it's anybody's guess, really, right? Our economist thinks there's going to be some cuts at the back half of the year. Who knows? I agree with what's been said. Credit availability, both CMBS as well as the bank market. The bank market has come roaring back. So rewinding the clock a few years, the bank market really shut down in 2022 as a result of inflation and capital ratio, regulatory capital ratio requirements were really tight. And the capital markets, CMBS market, which takes out a lot of our loans, was shut down. And so we had no runoff, no loan runoff, and we were all sitting on really tight capital ratios. So the bank market, full stop, really shut down. Roll forward into late 23 and into 24, as I mentioned earlier, the CMBS market came roaring back. Banks saw a lot of loan runoff, a lot of loan repayment, and about halfway through last year sort of woke up and said, well, my interest, we've seen billions of dollars repaid into the capital markets. My interest income has plummeted, therefore earnings are down. We need to redeploy this. Capital ratios are fine. We need to redeploy this and do it in a big way. And so we've seen a really 180 shift in terms of bank market capital. And as everybody here knows, the transaction market really has not come back to the levels they were in 21 and before COVID. And so there's a lot of bank capital chasing very few deals. There's a lot of refi activity and things like that, but what that's resulted in is really a benefit to you all investors is spread tightening, right? And we're seeing some really aggressive on balance sheet, both stabilized, non-stabilized pricing get done today. And that's just the nature of the supply and demand of what's available. So really good time from a lending perspective.
I think these guys covered it well. The only other thing I'd add is that the reason to feel good about that too is it is a bit of a reversion to the mean, because it is an anomaly when both the base rate is going up and spreads are widening. Yeah. Generally, they're balancing each other. And so we were in a really bad window for 2 years here of both of those moving against you. I think now with the runoff, with more availability of capital out there, we're seeing spreads tightening. Because at the end of the day, a bank is no different than anybody else. They're just caring about what their total return is. And as base rates stay elevated, they have room to bring in these spreads. And I think that's where there's opportunity for us as borrowers.
Outstanding. Thank you, gentlemen. Would love to open it up to the audience for questions. We do have a couple of microphones. So if you raise your hand, I'll point you out and we'll get you on mic. Don't all run to it now. Mm-hmm. Any takers? Yep, please. We got a mic up here, up front, please.
Thanks. Really appreciate the panel. A lot of helpful conversation on the lending front. I'm just trying to reconcile this tone that it sounds like there's a lot more lending availability, spreads are tightening, there's more capital around. Then from owners and folks on the deal front, there seems to be a lot of uncertainty out there, a lot of apprehension to move forward. So how long can these two things kind of stay seemingly disconnected?
I'm happy. I think that's a reflection of two different risk profiles. So I think for lenders at their detachment point, they can get comfortable with what they're seeing right now based on trailing and at least what is expected to happen over the next year. And the other thing is, like I was saying before, some of it has nothing to do with the deal. A lot of it has to do with the fact that if they have a bunch of money on their balance sheet that needs to get lent out, that's going to make them be a little bit more open to getting the money out the door. I do think that the apprehension is, well, one is just it's a very noisy news environment right now, so that kind of applies to anything and everything. But the bigger difference is more on the transaction side. There just continues to be a bid-ask spread. That's come in a lot over the last 12 months, I would say. I think part of that is your debt is getting cheaper, so that helps you lean in a little bit to pricing. And there is a lot of owners that are basically like, okay, it's probably time I'm going to have to just figure this out. It's not, my asset is not worth as much as I thought it was. And that, everybody knew that. Nobody just wanted to admit that to themselves. And so I think that you're slowly seeing a little bit more capitulation around that and just an understanding that if you don't have a specific business plan to explain why your asset is going to materially increase NOI, the market's not going to bail you out at this point.
Yeah, I think it's like underwriting discipline at least at Wells and our peers has not changed, right? We've not gotten more aggressive from a debt yield perspective or a coverage perspective. Where you're seeing the benefit is really in the pricing. And so again, you have a lot of banks chasing very few deals. We're not going to necessarily lend at a 4 debt yield, but what was 325 spread might be 275, might be 250 today. Than what it was 12 months ago. So we're still seeing, and I agree, we talk about it all the time in credit committee, is the uncertainty, RevPAR growth doesn't look like it's going to be as strong as it has been in prior cycles, and so wage pressures, all the things impacting the bottom line. There's more risk to bottom line declines than really upside opportunity from, again, a lending perspective. And so you just have to balance that and make sure your loan is structured appropriately. And frankly, you're doing business with your best relationships right now. So it's really leaning into your best relationships and your best borrowers and getting some price compression.
Thank you, guys. Anyone else? Please.
Yeah, just to follow up on that gentleman from Wells talking about conventional deals. You mentioned 65% loan to value. What's your sweet spot for debt yield and debt service coverage?
Yeah, it's a good question. So
Again, we will look at both stabilized and non-stabilized deals. And many of you in the room are borrowers. So if there is a big business plan, reposition, PIP, renovation, right? We can, and you have a track record with us of proving that out. And again, the data supports it. We can go in at lower debt yields, buying into the forward, and you might need a little incremental structure, whether that's recourse, whether that's again covenants, or some holdback elements. But we can go in at lower levels. So on the low end, we're probably in the 9 to 10 zip code, hopefully going to 12. On a stabilized assets, we tend to like to be in the 11 to 12 debt yield range. On a DSCR basis, it's sort of that 125 and up. Again, 125 sort of tends to be the floor. And on a stabilized asset, you'd expect really more in the 150 range.
Thank you. Still open. Anyone else? You have 4 fantastic experts up here. Let's berate them. Get whatever information you want, please.
My question is, if you don't have a property at the moment, but you are looking to be a first-time buyer, how would you build these relationships with these lenders and those of that sort to kind of, 1, learn the process, and 2, ask the right questions whenever you don't have an active property to be able to discuss maybe more specific details with?
Fantastic question.
So first-time hospitality owners, it's an upward struggle because there's a big learning curve. And there's really no way to get around it until you actually are out there trying to procure your first property. I joke around with JR that I'm part psychologist, part finance guy. And part of the psychology is, hey, do we take this jump? Do we not take it? Is this a good investment of capital? Is it not? Right? I think every hotel owner goes through it, but if you've gone through it enough times, it becomes a little bit easier. I would say, when you're first starting out, to keep the controllable risk as low as you can, right? A lot of very, well-priced assets seem to have a lot of, risk kind of built into it. It's a depreciating market. They're being sold for cheap. This is typically where I see some of the mistakes happen, is that first-time hotel owners, even if people that have got 20 years of experience into it, there's a very big difference between working in a hotel and actually owning one, right? They go into it like, we can make it work. And then it doesn't work. And that's where they wind up running into issues. So my suggestion to you would be to find a good deal that you can actually work, and then try to work your angles in terms of your equity if you want to put a majority of the funds down, or if you have a plan of renovations, work with a bank like GBank that can potentially take you, all the way up to 80% leverage, so where your cash reserves are still kept inside your pocket, and then potentially plan for an exit event down the road. Start there, build your portfolio, and then potentially branch out, to all the other wonderful investment vehicles that you have.
Yeah, and personal piece of history and my own family's history in hospitality. 30 plus years ago, my family's first loan was an SBA loan. They were successful business people in their own right, in their own industries, and applied for a loan on a property and a project that they could wrap their arms around, and they were able to execute on it. And actually, I bring this up because I found my dad's original SBA documents from 30-something years ago in storage, and I was shocked. I mean, it was 12% interest, 11.8 or 12% interest rates, and he still made it work, and he paid it down and paid it off. But having as Adil said, a property you can wrap your arms around and a business plan you can execute on. I think those are the 2 biggest criteria, and that's what a lot of the thesis of what the SBA is built on is that.
I was going to say fake it till you make it, but that's much better advice.
Yeah, you want to be looking at simple things. As Adil said, you want to keep the risk minimal, so you want low key count. You want to be limited service, economy scale. You don't want a massive PIP. Keep it really, really simple. The small 40, 50, 60 room hotels at the economy level, where the brand is not going to expect massive renovations over time. That's really what you want to focus on. To get the industry experience, you want to either own another business of another type, or just be a GM and be more proactive. Be like, hey, I'm going to do the repairs. I'm going to help even with turning rooms over. You want to show lenders that, hey, I have the experience to manage and operate this hotel on my own, basically.
Wonderful. So a few key takeaways. Abundance of liquidity in the market. And guys, feel free to jump in if I'm off base here. Abundance of liquidity in the market. the sort of 12 to 18 month forward looking is optimistic in terms of availability with pricing tightening. Availability of debt for both cash flowing and non-cash flowing today and continued to be, so long as there's strong sponsors with a path to a completion of a business plan, a PIP, a renovation, or a repositioning. Anything you'd like to add?
No, I would just add, I mean, look, it's two things. Be creative, right? There's a lot you can do within the four corners of a loan document. So design something that works for your business plan, and work with a lender who's willing to do that. Hire a good lawyer who understands, so that you go in eyes wide open with everything. And two, look, and I mean this, your banker should really be one of your best friends, right? And I say that a little facetiously, but it's true, right? The banker is your banker is a person too, and it's just human nature. If you're my client who's also my friend, and you call me up and say, I need some relief here, I'm going to work so much harder for you to get you the relief that you need than somebody who treated me as a transaction. It's just human nature. So play the long game with your lender. Be open, transparent, and really treat them as a partner, and that will go a really long way.
And JR pointed this out earlier, relationships matter.
Yeah.
You know, we keep talking about debt yields and math. I mean, we're all kind of math junkies, but you know, it's a relationship-based business, 100%. You know, your banker can pretty well size up a deal from a completely different angle than perhaps you can see the forest from the trees, can advise you a little bit better. So I mean, that's one of the major things, is that, you know, you have to have a circle of a team that is willing to work with you to accomplish your mission. There's actually another hotel entrepreneur here who still gets conventional financing off crazy projects, and I've never seen, you know, deal sheets like the ones that he has. But that's because he's got 2 or 3 banks that he works with. They trust him. They know, you know, what he can do. They know that he's got their backs protected, and so on. So it plays a big deal. It plays a big part of you know, your own brand.
Wonderful. Thank you all very much for sitting with us this afternoon. Greatly appreciate it. Please, a big round of applause for our panelists here.